Good evening. This is Tim Wander in the Fredericksburg office. Who do we have on the line? Okay.
Hi, this is Chris Ratliff in Plaza.
Christy Bodheim at Plaza.
Darrell Wells, Plaza.
Okay, for Plaza folks, are you all in one conference room or are you calling from your desk?
Desk.
In the desk.
Desk
Yeah,
one, okay.
calling in from the desk.
Okay. All right. Do we have anybody from Virginia Beach on the line?
Hunter Phelan here from Virginia Beach.
Okay, Hunter, are you in a conference room or are you folks calling in from your desks?
I'm at my desk. I'm not sure. I think there's a room available. I didn't really know what to do.
Okay. Either one is perfectly acceptable. I know I have some folks.
I'm here at the Plaza.
Okay. All right, it's a 4:59, so we'll give another minute or so here for people to join. Can you see the first slide on screen?
Yes.
Okay.
Yes.
All right. Success. Okay, just to bear with us, we'll give folks just a little bit of time here to dial in.
I am on. We're on. We're on mute, but we are on.
Okay, who's we?
Myself, Diana Floyd, and Catherine Lombardo.
Okay, and you are from the which office?
Region 7, Virginia Beach.
Okay. All right. I tell you what, so I want to go ahead and get started because one of the things I promised to do is not keep you any longer than what the class time is allotted for, which is from 5 to 7. So you should be able to see on screen risk for finance, finance risk management, insurance. So what I want to do is go ahead and get started. I know we have, I think, an associate from the Buffalo office calling in. We have a number of people from Virginia Beach, Plaza here in Fredericksburg. We have 5 or 6 people. I know one individual from Fredericksburg emailed me today. He wouldn't be here. Today was his birthday, so he wasn't going to be here. Can't imagine why you'd want to go anywhere else other than CPCU540, your birthday. But so total, we have about 31 people signed up for the CPCU540. I know some of you may be taking this because it's required, one of the required courses for management. Others of you may be taking this because you just have a burning desire to learn about corporate finance and insurance, which I'm sure is probably the majority of participants in the class. And some of you may be taking this because you want to go to Hawaii in 2016, and you need to complete this CPCU course to help you complete all of the requirements for CPCU. You can go to Hawaii for the annual conferment ceremony. If that's your goal, certainly go for it. I've been there twice, 1995 and in 2007 for the conferment ceremony when it was in Hawaii. It's worth the effort. But we'll get you there. So what I want to do is, one, we haven't really had, I've been teaching this CPCU 540 course now probably for 8 to 9 years. And usually it's been either in the classroom environment, either the Plaza or here in Fredericksburg. And a few years ago, we also did it down in Macon via video conference. So I had a group at the Plaza and a group in Macon, and we did a video conference. This is the first time we've done it with just WebEx. I've done a WebEx before when I taught at the Plaza. I had somebody in Fredericksburg join in via WebEx, but we haven't done it on this large of a scale. I think they wanted to try this with this CPCU 540 class and also CPCU 530, which is the business law class. that is also being taught via this WebEx, and if this format works, then we're probably going to see more of this going forward, because then we can do like we are here, we're hitting 4 locations all at once. So I know with this number of people in the past, when a smaller group have gone around, so we know who we are, what areas of the company we represent, how long this is your first CPCU course or your last one with that large of a group. We could burn up a half hour just going around the virtual table. So I'm not going to do that, but what I would like to know is what areas of the company we have represented by people here on the phone. And so what I want to start with Plaza, if you just go around and just say, so everybody knows, what department do you work in? Do you work in HR? Do you work in URC? Do you work in PPR? Where do you work? So I'm going to start with the Plaza folks first. And if you just shout out what department you work in so that we all kind of know what areas of the company are represented here.
Hey, this is Christy. I'm with CALG.
Okay.
Here with HR.
This is Frank with State Filings.
Yes.
This is Chris with CALG as well.
Daryl,
This is
MSI.
Megan from PPR.
Okay.
This is Pamela from CR as well.
From PPR, okay. For those of you who don't know, PPR stands for Pricing, Product, and Reserving Department at the Plaza. Okay. And CALG is, I think most of us know, the Competitive Advantage Leadership Group. Okay. Do we have anybody, our associate from the Buffalo office on the line? All right, let's skip down to Virginia Beach. For the folks who work out of the Virginia Beach office, what department do you work in?
This is Ripple German. I'm in claims. See you.
Okay.
Hunter, I'm in claims as well, TCR2.
All right.
Diana Floyd. Diana
Go ahead.
Floyd in claims, TCR1.
All right.
Catherine Lombardo, TCR1 in claims.
Okay. Anybody else from the beach? Maybe they're out on the beach. Probably with their CPCU textbook. Sure. All right. How about here in Fredericksburg?
Melanie, Moat Sales.
Boat sales, okay.
They're auto service.
Auto service,
Millie, Moat Sales.
boat sales, claims.
And I'm Erin. I'm our CSR trainer.
Okay. All right. One of the reasons I asked that because especially it's a bit interesting we get to later chapters and we have our claims folks on the line and talk about doing structured settlements as an example of an annuity. And so we'll actually talk about that when we get to that chapter. So if some of you in claims who have handled structured settlements before and you want to do that with an annuity, we'll actually go through the math mechanics of how do you determine the present value of an annuity, which could impact what you might want to pay out on a settlement, for example. But that's chapter 6. All right, I'm Tim Wander. I work in the Fredericksburg office, but also I belong to URC, Underwriting, Reserving, and Control, which is out of the Plaza. I kind of bounce back and forth between the two offices. I got my CPCU designation in 1995, and I've been pretty much teaching CPCU courses ever since because I love this stuff. This is fascinating material. I've been teaching this course for about 8 years. The good news is my success so far, I've beat the national average pass ratio for this course for a number of years, so that's good news. This course in corporate finance, again, I got the CPCU in 95. Also have an MBA from Virginia Tech. And this corporate finance course, they come out with a current text that you have now for the last 4 or 5 years. Before that, they were using the actual textbook for MBA students. The first course for MBA students in corporate finance was the textbook for this CPCU class. They had that for 2 or 3 years, and then they changed that to the course in its current format. One thing I want to touch right off the bat is I've gotten questions already from people on calculators. What kind of a calculator do you need for this class? All of the calculations in this class can be done with a regular calculator that does nothing more than add, subtract, multiply, and divide. So you do not need to go out and spend money to buy a financial calculator or some TI instrument or HP business calculator. Everything you can do with a regular 4-function calculator. When we get to those chapters where we'll actually be doing some calculation, I'll let you know ahead of time to bring in a calculator because we'll go through some of these problems. On the national exam, they will give you formulas for some of the problems if there actually is a question where you have to work through a formula. But when we get to that chapter, chapter 6, which covers present value and future value, we will actually work through some formulas in that class. We'll work through the formula. We'll work through it using tables, which are provided to you in the exam. And those of you who have a financial calculator, yes, you can use that too. If you go out and buy a financial calculator, do not wait until the day of the exam to learn how to use it. Now, as far-fetched as that sounds, I've had students in the past who did exactly that. They waited until the exam to try and learn how to use a financial calculator with commensurately disastrous results. Don't let that happen to you. Okay. As we go through, ask questions. Feel free. This is a discussion. This isn't going to be me lecturing for 2 hours. That put me to sleep, let alone anybody else. Also, we're going to talk about, as you see when I sent out that email, I think probably to most of you, the first one, I put in some copies of some formulas, present value, future value. But we're going to cover those. I'm going to present those in every class, even though we won't see it until chapter 6. Now, I do that for a couple of reasons. One, because you get exposed to it, you'll see that so when we get to chapter 6, that's not going to be anything new. And also I found that those concepts of present and future value underlie a lot in the field of finance. And as you see when we get to the chapters, you will find them personally useful. And we talk about putting our monies in a 401k account, you put money into an IRA account. GEICO makes a profit-sharing contribution every year, and you put that into your 401k account, and that earns an interest rate of X%. And you put it in there every year. GEICO puts in 10% of your salary if you have profit-sharing in your 401k. Well, if that happened, and you have 20 years to go before you retire, or 30 years, or 40 years, or 10 years, what would the value of that money be in 20 years from now? We'll walk through how you can actually calculate that. Now, Vanguard will actually calculate that for you, but why let Vanguard have all the fun? We'll kind of do it ourselves so you can see how to do it, all right? But also I want to take a look at, because a lot in finance is impacted by what's happening in the actual market, and we talk to you later chapters, we're going to talk about the different markets, the NASDAQ, the New York Stock Exchange, the European Exchange, Asian Exchange. Well, let's take a look at what some of those are actually doing. And for us, it also impacts probably what your results are in your 401k account. Again, basics of corporate finance. This is the chapters. There's 12 chapters. GAAP, financial statements. GAAP is generally accepted accounting principles. You think, oh my gosh, do I have to have had an accounting class? I've taught this class in years past, and people who have taken it and were successful on the exam never had an accounting class in their life. Or it's been 20 years since they looked at an income statement or a balance sheet, and they are successful. And you will be too, right? So we're going to make it easy. You don't have to be an accountant to understand this. SAP, statutory accounting principles, and talk about the difference between GAAP and SAP, because that impacts us as an insurance company. Cash flow valuation, that's present and future value of lump sum, of annuities, bonds and stocks. Well, all right, so IBM stock closed yesterday, or Apple stock closed yesterday at $117.34 per share. Theoretically, how is the value of that stock determined? Why is it $117? Why is it not $150? Why is it not $80? What impacts and what determines the value of stock? We're going to look at that and we'll see, all right, here's how stock prices are actually determined. Same thing with bonds. We'll talk about insured investment portfolio management, our capital needs, what is capital, and then capital management, M&A, mergers and acquisitions in this underwriting cycle. Stocks and bonds, that's going to impact us quite significantly when the Federal Reserve does whatever they're going to do this month on interest rate movement, whether they're going to increase the federal funds rate, which is going to increase interest rates. That's going to impact the value of stock, impact the value of bonds, impact the value of your 401k. Also impact the value or the cost if you want to get an auto loan, a mortgage loan, credit card, interest. It's all going to be impacted by what the Federal Reserve does when they take action on interest rate movements. We'll talk about that as we go through the course. Because I want to make sure that, yes, you can read the text and it's wonderful all in its own right, but let's apply this to the real world and see how what we're reading about actually works in the real world. So we're going to talk about that as we go through. Again, these are the formulas for present and future value. I put them in there, and I learned this way back when, decades ago, when I was an undergraduate, long time ago. And I remember them ever since, but it's been useful to me ever since. Not only in my job at what I do here at Geico, but also personally when you're looking at your own finances, you're looking at your 401k, these concepts of present and future value, the time value of money are important. So I present them here. We'll be revisiting them as we go forward. One thing I guess I didn't say, when I work in URC, Underwriting, Reserving, and Control. I'm Geico's corporate risk manager, which gets me involved in a lot of different stuff. But actually, I use these present and future value concepts and formulations, not daily, but at least a few times a week, all the time in what I do. So they have some real life applicability to what we do here at Geico. These are the educational objectives. For some of you, let me just see a hand in Fredericksburg here. Is this your first CPCU course or your one of many? First, couple first. All right. So for those of you on the phone, if this is your first CPCU exam, I want to spend 8 minutes.
Yeah, this is the first class for me, but I'm also taking the intro class as well right now.
You're also taking the intro class, okay?
Yeah, foundations.
All right. If everybody has your finance and accounting, you have a textbook and a course guide. If you would, go to your course guide. And so I'm going to take a couple of minutes here so that if this is your first or your last CPCU, kind of explain this course guide is very useful in a number of respects. So let me just kind of walk you through this course guide. Again, turn over to Roman numeral page 5. It's like the 2nd or 3rd page in. Roman numeral page 5. You'll see on the left-hand side, that page is titled Student Resources. Roman numeral 5 talks about more study aids, review questions, application questions, so you can see that we're all on the same page. Look on that Roman numeral page 5 on the left-hand column. You'll see some words: analyze, apply, associate, calculate, classify, compare, etc. why I bring this to your attention on a CPCU exam, be it this one or any CPCU exam. When you see words compare, show similarities and differences. Contrast, show only differences. You want to make sure you know what the institute means by these words. Because if you see in a multiple choice examination question that says contrast the difference between present value and future value, they're only looking for an answer that talks about the differences. And so if 3 of the 4 answers talk about the similarities, well, you know right off the bat, those are not the right answer because contrast means differences, so find the answer that talks about the differences between those two. So spend a few minutes reading through this so that way you know what they mean by these various words. Okay, flip over a page. It talks about the CPCU540 exam. Again, it's a multiple choice exam. Again, I'm not going to go through this, but part of the value of a textbook or study guide is I always read the introductory material. There's information in there that will be helpful to you as you study the course as well as being helpful on the exam. You will not be able to use a smartphone, a dumb phone, any kind of phone on the exam. So if your 4-function calculator is your smartphone, you're going to have to get another calculator because you cannot use smartphones, dumb phones, at all phones during the exam. If you have a calculator that has programmable keys on, like alphanumeric keys, you will not be allowed to use that on the exam. They don't want you to have a calculator that would allow you to go in and put in text wording, essentially examination answers. So again, that won't work. All right, and again, you'll see that the question, is there a common mistake that students make when trying to solve CPCU exam problems with a financial calculator? Yes, trying to learn how to use it right during the exam. So don't let that mistake be yours. Okay, flip over, Roman numeral page 8, formulas and tables accessible during the CPCU exam. So during the exam, you'll see these various financial formulas that will be available and presented to you on the exam. So if you see an examination problem where they're asking you to calculate the present value of some amount compounded over n number of periods at an interest rate R, all right, well now here's the formula. You don't have to memorize the formula. You just have to know how to use it. Or you can use tables, which you see the very next page. It says future value of $1 at the end of the end period. So when we get to Chapter 6, we will walk through doing finance problems, present value, future value, either working through the formula or using these tables to answer the problem. These tables will be available to you on the exam. They make doing these kind of calculations much easier. All you need to do is add, subtract, multiply, or divide. Okay. All right. So again, those are tables for present and future value of lump sum and annuities, and know that they are there. And we will spend more time with those when we get to chapters 6 and 7. Okay, questions so far before we start going further? From anybody in the beach or the plaza? All right. What I want to do is the educational objectives. The people who write the CPCU exams write the examination questions from the educational objectives. So if you can answer the educational objectives that are in the study guide, I'm going to pick the first one that says, explain why it is important for insurance and risk management professionals to study corporate finance and accounting. If you can answer that question, you're going to be able to answer those questions on the exam. They write the examination questions from these educational objectives. If it's not in the educational objective, you're not going to see it on the exam because they base those out of these educational objectives. No. I guess one thing before we go further, flip back open to the very inside cover of your study guide. Go to the inside cover. And you'll see in the lower right, in the lower bottom, unless you page of that inside cover, you see something that says to activate your smart online practice exam, go to this website and enter the access code below. This will allow you to log in and take online practice exams. If you don't come to another class, if you don't listen to anything else I say the rest of the course, go to this site, register, a couple mouse clicks, put in this access code that allows you access to the exams, and take the practice exam questions. There's almost nothing better that you can do to prepare for that exam than to take those examination questions. Now, if you go to the Institute, also, if you have a smartphone or an iPad or an Android tablet, there's also an app. Of course, there's always an app for anything. There's an app that you can buy, $9.99. You can download on a smartphone or a tablet. It has a bank of about 700 questions for this course, practice exam questions. Now, if you don't want to do that, I don't have to go and spend $10. Fine, I can go on my computer at home or your tablet at home, go to this website, register, put in your access code, and you can get access to the practice exams on every chapter. Use those practice exams. If you want to be successful on the exam, use those practice exams. I've had student after student after student after student tell me, not only for this CPCU540 class, but for other CPCU classes as well, one of the things that help them best is to take those online practice exams. So, do it. Now, this is Chapter 1 today, so before we start talking about Chapter 2 next week, I will expect that you will have taken some time to go and do these online practice exams. I already have for Chapter 1.
Hi, question.
Yes.
So on the website, is it only full exams, or do they have practice exams per chapter?
They have practice exams per chapter, and then at the bottom of that page, they actually have a link where you can take a full exam over the entire course. So essentially all chapters. So we'll mix up questions from all chapters. Or you can go chapter by chapter by chapter. But please avail yourself of this tool that will help you be successful on the exam. Then that'll give you a feel for how they word the exam, questions, kind of what they ask for, and that'll give you a good sense for what's on the exam. No. Sky is the limit. Of course, after a while, you'll start to see some of the same questions again. Right. So now, when I sent out the previous email, I said there would be a quiz at the end of this course, at the end of this class. That's true. So what I will do is I'll log on to the site. We're going to pull up the quiz for Chapter 1, and we're going to do it. And we're going to do that every week on every chapter. All right. That's going to be our quiz, because those are just like what you'll see on the real exam. So by the time you're done, you will have gone through, if not on your own, at least every chapter one time, because we're going to do it in class on every chapter. So you'll get a sense for what those examination questions look like. I talked to an associate who just took CPCU540, which is personal insurance and risk management, and he did the online practice exams. There are 700 questions in the exam bank. He did them all. You know, and if you missed, then you go back in the text, you look it up, so you understand where the answer is. And he actually saw on the real exam, not the exact same question, but the same material, just question worded a different way. So again, if you go take the online practice exams, you'll see everything in the practice exam that you're going to see on the real exam. It's going to be worded differently, but at least when you see it, you'll have an aha moment. I remember that when I was taking the practice exam. That was the answer. That'll, again, help you to be successful on the exam. Right?
How many questions are on the exam, and what's the passing score?
I believe there are either 80 or 85 questions on the exam, and the national pass ratio is 72, 73%.
So you need a 72 or a 73 to pass it?
So you need a 70 is the minimum score to pass a CPCU exam. Get a 69 and a half, you don't go forward. Now, there are some people, myself included, I did not ever fail the CPCU exam. There was one exam I liked so well, I went back to take it again. I never failed the exam, right? I couldn't say that word, but I liked it so well, I went back to take it again just for fun, which I'm sure would be the case here. All right, so let's dive in. So this is what we're going to talk about: goals of corporate finance, concepts underlying GAAP accounting, international financial reporting standards. So the first education objective: why should we study corporate finance, other than because it's fascinating in itself? Here are some questions for you. When should a producer or risk management professional examine financial statements? Now, anybody here a producer, so that's anybody in sales or service, for example, when would you look at financial statements?
To help make an underwriting decision.
To help make an underwriting decision. Okay, how does looking at a financial statement help you make an underwriting decision?
Because it can be a predictor of future behavior. So if a person has, like for us, in homeowners, unfavorable credit, statistically they have a higher loss frequency.
Okay, perfect answer. You're exactly right. All right. Did everybody hear that?
Can you repeat it again, please?
All right, well, they use it in homeowners. Here in Fredericksburg, we have the mode operation. And certainly they use that in underwriting of homeowners policies because people with adverse credit, for example, statistically have a higher propensity to have a loss. I mean, in a sense, producer financial statements, even on auto sales and auto service, we're not looking at policyholders' financial statements. But in the background, we have our CAU model or Karma model. It's actually going out, pulling in people's credit score, which is an indicator of their financial wherewithal and their financial responsibility, and that is a component of our underwriting model for placement of auto insurance. So even GEICO, yes, we use it in homeowners, and we also even use it, if not explicitly, implicitly, in our auto underwriting. Examine financial statements. I can tell you I look at GEICO's financial statements, one, to help identify insurable or non-insurable exposures that we have of GEICO Corporation. And for certain lines of insurance, underwriters for our corporate insurance policy, I have to provide copies of GEICO's corporate financial statements to underwriters at companies for certain lines of insurance. They want to see what our assets and what our liabilities are, what our owner's equity are. Okay, when do claim representatives use financial statements? So for folks in claims, when would you use financial statements?
We use them a lot in claims.
Okay.
In CCR2, like lost wage, if people are trying to say, oh, I lost wages, especially in business, we need their income, their business statements, their accounting statements. We have to know how to read those so we know what they lost.
Right.
They have to prove loss of income.
Okay. Okay, now your answer there just raised an interesting question. So in our claims training, do we actually cover how to read financials?
It is an on-the-job training. When you get one, you learn.
When you get one, you learn. Wonderful. Okay.
That's why supervisors have to learn.
That's why supervisors have to learn. All right. So what types of information are revealed on those statements?
What their income is, what their interest was before the loss. So it's not always income. Income is what we see the most, but right. Even if they had property, what kind of property value did that property have before the accident? Was it depreciated? How old was it? We have to calculate depreciation, so how much money did
are absolutely correct. Anybody else on the phone have some examples that you've used in your job here at Geico on financial statements? Again, because if you have examples, that's what brings this stuff to life, because we can talk about the theory all day long. We talk about assets and balance sheets and income statements and the statement of changes in owner's equity all day. But if you have some real examples, that's what brings this stuff to life. What is the goal of corporate finance? Well, in the textbook, it talks about maximizing shareholder wealth. Okay, what does maximizing shareholder wealth mean? Does it mean maximizing profit cost, market share, minimizing or maximizing value of the company's stock? What do you think maximizing shareholder wealth means?
It's maximizing the value of the company's stock.
Right. Now, can you do that by maximizing profit?
No, because you don't want to focus on profit because it could hurt you long term.
Right. Right. And then similarly with minimizing costs, well, you could minimize costs at the expense of being able to service your customers and provide a product. And so again, that's not maximizing shareholder wealth. Now, so in the textbook, it talks about maximizing the value of stock. One caveat to that, in the real world, if you remember back in the year 2000, there was a company called Enron, and they undertook a number of activities to maximize the value of the stock of the company. A lot of those activities were unscrupulous, unethical, some of them illegal, but it maximized the value of the stock until this house of cards they had built collapsed, and then the value of the stock went to zero, and they went bankrupt. At one time, Enron, in terms of market value, was the sixth largest company in the United States in terms of market value. The sixth largest company out of all the companies in the U.S., they were the sixth largest, and they went down to zero. They tried to maximize the value of the stock through lots of illegal and unscrupulous activities. So, yes, this is the goal. However, there are some caveats to that as well. Okay, another goal of corporate finance they talked about in the text is financial transparency. Certainly know that a lot here. At Geico, it's providing timely, understandable, and accurate financial reporting. It talks about the Sarbanes-Oxley Act of 2002, and a lot of that, the impetus for Sarbanes-Oxley came out of the financial debacle of 2000 and 2001. The Enron and the WorldComs, for example, gave rise to this Sarbanes-Oxley Act, which improved the accuracy and reliability of corporate disclosures, created greater regular oversight, enhanced financial disclosure, increased penalties, financial information certification. So, to give you an example, once the Sarbanes-Oxley Act passed, it also created it was a full employment act for armies of consultants and accountants and CPAs who help companies in compliance with this. It created lots of opportunity here at Geico because also we had to do SOX compliance. So there's lots of people involved in SOX compliance. That last bullet, financial information certification, if you go out and read Berkshire Hathaway's annual report, Uncle Warren, and the CFO, Mark Weisberg, for Berkshire Hathaway have to certify the financial statements for Berkshire Hathaway. So if you think about it, Berkshire Hathaway has 60, 70 subsidiary companies. Geico, Fruit of the Loom, Acme Brick Company, Shaw's Carpet, General Reinsurance, National Indemnity Insurance, Northern Railroad. They have to consolidate all of the financials for those various subsidiary organizations up into Berkshire corporate financial statements, and then Warren and the CFO have to sign off certifying the accuracy and authenticity of those financial statements. That did not exist prior to this Sarbanes-Oxley Act passing in 2002. Okay, another goal of corporate finance, ethical conduct. This is what certainly I know Warren Buffett talks about. You have a company code of ethics. I mean, even before Geico became part of Berkshire back in 1995, we had a code of ethics. And what they talk about in the text, you don't want to do something that's going to appear on the front page of the newspaper or on TV and with your family and your friends approve of your behavior. And that's kind of the yardstick to use. There was an article that came out several years ago in the Wall Street Journal where Boeing Corporation, got into trouble. They had a senior officer at Boeing. The Air Force is trying to get Boeing is trying to get a big contract with the United States Air Force to build tankers in field for fuel tankers for in-flight refueling. And so there's a senior officer at Boeing was working very closely with a high-ranking individual in the Pentagon to secure this contract, which is worth about $100 billion. All right, so at the end of this period, they finally Boeing got the bid, and then this senior officer at the Pentagon also left and all of a sudden became a senior officer at Boeing shortly thereafter. And then they started, wait a minute, this looks a bit funny, so they looked into it and they found a bunch of ethical violations where the officer at the Pentagon was helping steer this contract toward Boeing for $100 billion. At the time, why did this hit the Wall Street Journal? At the time, Boeing Corporation, as big as Boeing is today, they did not have a code of ethics. They didn't have a code of ethics. They were a Fortune 100 company. So it was shortly after this, and it hit the Wall Street Journal and hit the press, and then a couple people at Boeing lost their job, and they almost lost that contract. Boeing CEO came out to their management and said, we need a code of ethics that all Boeing employees are going to have to sign. Now, when they did that, and I remember this from the article, the CEO said, well, we need this. And so the HR VP was looking at her calendar and said, all right, well, we can have this in about 3 months. I said, no, you're looking at your calendar. I'm looking at my watch. We need this in 3 weeks. For 3 weeks, they had a company code of ethics. And all Boeing employees had to sign it, and now every year they have to sign a code of ethics. Similar to what we do here at Geico, right? And we have that annual Geico University course that we have to take on our policies and procedures. So again, what's one of the goals of corporate finance? So what? You maximizing shareholder wealth, financial transparency, and ethical conduct as goals of corporate finance. What are some of the finance activities of a corporate finance department? Working capital management, capital structure, capital budgeting, accounting activities. In later chapters, we'll spend more time talking about capital budgeting. That's going to be chapters 7 and 8. Accounting activities we're going to actually talk about next week when we get to GAAP and statutory accounting principles. Capital structure management comes along in chapter 10 and 11. Working capital management, we'll touch on it briefly this week, and then that comes up here in another 2 weeks as well. All of these are activities that are financed in our controllers department at Geico. They do this every day. They do all 4 of these every day. In one way or another, the various activities they undertake impacts each of these types of activities. Now, I'm going to step out of the chapter for a second because when we talk about financial statements, that some people have never seen an income statement or a balance sheet, or it's been a few years since you've seen one. It doesn't do us a whole lot of good to talk about that if you don't even know what it is. That's why I'm going to take a couple minutes here and talk about what is a balance sheet. The snapshot of the firm's assets and liabilities at a given point in time. So a balance sheet as of 12/31 2014. A snapshot at a point in time. It lists the assets and the liabilities of the company. Assets are listed in order of liquidity. Current assets, long-term assets. The balance sheet identity, this formula, assets equals liabilities plus stockholders' equity. I wouldn't say commit that to memory, but I would say commit that to memory. But we're going to come back to that formulation in later chapters. That helps you understand some of the concepts. If you just remember, assets equals liabilities plus owner's equity. When we get into later chapters, we'll actually do some formulas where you're going to have to know this, but to make it easier to remember this, we'll actually work through and talk through some applications that make it easier to understand. So then it's not an issue of, I have to memorize the formula versus I already understand it. I don't have to memorize it because you'll understand it and it makes sense. I mean, you don't even have to think about it. So this is a picture, if you haven't seen it before, of what a balance sheet looks like. Again, you see add current assets, fixed assets. Think of in terms of decreasing liquidity. So you have current assets, cash, accounts receivable, inventory, and then net fixed assets. So cash is certainly, accounts receivable is less liquid than cash. Inventory is less liquid than accounts receivable. And again, going on down. Accounts liabilities, again, liabilities are listed in order of when due. So accounts payable, salaries payable, notes payable, those are due before your long-term debt. So again, you have assets, liabilities, and then you have a category called owner's equity. One, remember that the assets is equal to liabilities and owner's equity. The balance sheet has to balance. If ever in your life you see a balance sheet that does not balance, run the other way. It's wrong, and whoever put it together is wrong because there's something not right if they don't balance. They have to balance. But when we talk about capital structure, note you have liabilities and owner's equity on the right-hand side, but only assets on the left-hand side. So think of it as liabilities and equity support and underlie the assets. I'll give you an example. You go out to buy a car. $20,000 is the price for a car. You have $2,000 of your own money you're going to put down, and you're going to get a loan from the Geico Credit Union for $18,000. So your liability, in this case, is $18,000 loan you took out from the credit union. Your equity is the $2,000 that you plunked down to buy this car. That $18,000 loan plus the $2,000 in equity is total $20,000. The asset that you just purchased is a car that's worth $20,000. So assets is equal to liabilities plus owner's equity. And in this case, the capital structure, liabilities and equity, underlie and support the assets. So that car loan that you got plus your $2,000 of your own cash is the capital that supports the asset that you just purchased, in this case, a car. Well, same thing for a corporation. You have liabilities, equity, and that is your capital structure that supports your assets. There's a balance sheet for you. All right, we're going to talk about some of the accounting activities that are undertaken by most companies, either their accounting department. All of these, Geico's financial departments are engaged in. Again, this activity is focused on obtaining, managing capital, be it capital, using the example we just talked, you can have capital as either liabilities or capital can be equity. So they have various financing activities on obtaining and managing capital. So what could that be for a corporation? Well, for example, if a corporation wants to go out and buy something for $50 million, are they going to use cash Are they going to go out and get a bank loan to buy it, or are they going to issue bonds? The bank loan or bonds, or both of those are examples of liabilities. Or are they going to use their cash, or are they going to go and issue stock? And the proceeds from that stock being equity, to help purchase that asset. So again, those are the types of activities that are focused on obtaining and managing capital. Activities focused on accumulating and reporting of financial data. Well, at GEICO, as you can imagine, we do a lot of that. We have to accumulate all of the financial data, all of the policyholders paying premium, written premium, earned premium, and then we have lots of financial reporting that we have to do, not only to Berkshire, but we have financial reporting we have to do to a lot of regulatory authorities. We also require lots of financial information on GEICO. Financial statements provide information for corporate finance departments used to make decisions. Well, if you think of it for a regional office, be it Fredericksburg, Region 1, or Virginia Beach, our various regions have profit and loss statements, P&Ls, right? So our corporate finance department uses information on payments paid out by claim policyholders in Virginia Beach office that roll up to Virginia Beach, as well as premiums received, come up with profit and loss statements for the Virginia Beach office. They do the same thing for Plaza, same thing for Tucson, same thing for San Diego. So there's lots of aggregation of financial information by this corporate finance department. And again, they can be used by internal and external. In many cases, they require use of both. All right, when we talk about working capital, what is working capital? This is a pictogram of what working capital is. Current assets minus current liabilities. That's all it is. So if you see an examination question, which you will when you take the practice exam for Chapter 1, you're going to see a question on what is working capital. Well, is it fixed assets minus long-term debt? Well, no. Is it current assets minus shareholders' equity? No. It's current assets minus current liabilities. That is working capital. This is also a picture, if you will, of another balance sheet, right? Current assets, cash, accounts receivables, inventory. Or in our case, premium receivables. You have fixed assets, the building that you're sitting in, the fixed asset of GEICO. What's an example of an intangible asset? Intangible asset.
Maybe be the premium.
GEICO's brand in the market.
Right. GEICO's brand, our reputation.
Trademark and copyright.
Trademarks and copyright. Correct. Those are intangible assets. Can't really put your hand on it, but that's an intangible asset. And then again, liabilities broken down between current, long-term liabilities, and then shareholders' equity. But what you want to remember out of this is working capital. Current assets minus current liabilities. Give you another example. So, and I usually when try and explain this to my daughter. Current assets, working capital. All right, so if your current asset is your paycheck, your cash, money that you get, $1,000, right? You got $1,000. That's your current asset. Current liabilities, well, you got to pay rent. Rent is $800. What is your working capital? How much? $200, right? Current assets minus current liabilities. That's all it is. Current assets minus current liabilities. So after you've met your current obligations with your current assets, what is the capital that you have to work with? In this case, $200 to pay for everything else. That's an example of what is working capital. All right, capital structure. What is it? It's again the mix of sources of funds, debt, preferred stock, common stock. Now, if you're not sure what is preferred and what is common stock, not to worry. We're going to spend some time with that when we get to Chapter 7. The amount of debt is the firm uses to finance is called leverage. Oftentimes you'll see what is the amount of leverage. Now, I know a few years ago there was a TV show called Leverage. I don't know, some detective or cop show. So I asked my daughters, okay, studying CPCU540, what's leverage? And they told me, oh, it's this TV show on TV. No, it's the difference here. It's when you have to issue lots of debt. We'll spend more time with leverage when you get into chapters 10 and 9 when we talk about capital structure. But again, going back to our previous example, you're buying that car, $2,000 in equity, and you put down $18,000 loan from the credit union. A firm with a lot of debt in its capital structure is said to be highly levered. Well, in that example there, on a $20,000 in debt for $20,000 asset, $18,000 of that was financed with debt. So in that example, you are highly leveraged. You have a lot of debt. Well, same thing for a corporation. And again, capital structure can be viewed as permanent financing represented by long-term debt, preferred stock, common stock. And again, just think of capital structure is that structure of capital, and capital is equal to debt and equity that supports the assets of the organization. Capital budgeting, we get into on chapters 9. But they talk about in the text, again, one of the activities of the corporate finance department, it's the planning and managing a corporation's long-term investments. They can be tangible or intangible assets. Again, we'll look at this lovely formula here at the bottom, net present value. That formula will be second nature to you by the end of chapter 9. You can do that in your sleep. Okay. You look at this, oh my God, this is so easy, even a caveman can do it. All this says is the present value is equal to what? Cash flow. That CF is cash flow. I'll give you an example. Oh, this is back in the mid-90s over at Print Mail Center. We were looking to buy some new printing equipment. High-speed printing equipment to print policyholder paperwork. Current machine was an older machine. We had 12 people whose job was to care and feed for this machine. We spent $600,000 to buy this new machine to produce paper faster, etc. And we don't need those 12 people anymore. We only need one. So that CF0, cash flow at time 0, is $600,000 out. The cash flow coming in was the salary and benefits that we would no longer have to pay for those 11 people. Net, those benefits and costs foregone against $600,000 cash outflow. What is the net present value of this investment? And should we undertake it or should we not? We'll have fun with that in chapters 10. I can tell you the result of that was we went and we spent $600,000. We bought the piece of equipment. And what did we do with those 11 people? Did we lay them off? Right. No. We just moved them to another department. But theoretically, on paper, it was a positive net present value. Right? The benefits were greater than the cost. And so undertake the investment. We'll spend more time with that in chapters, again, 9 and 10. But again, this is another function of capital budgeting. Some of you know we had that new office in Houston. And we're leasing that office. Years ago, we were going out and build a new region, say down in Lakeland, or even when we built the Virginia Beach office. Well, we're going to spend X amount of dollars building that office. What is the return that we're going to get in exchange for building an office? Well, we're going to be able to put X number of people in there. We're going to be able to generate more sales, more revenue, more premium, more policyholders. The the value of that investment was greater than its cost. Here in Fredericksburg, we have what we affectionately know as the shed behind the building, which is nothing more, there's no people who work in that shed. I've been in there a number of times. It's all full of equipment for power generation, power our data center down in the basement of the Fredericksburg building. So we spent several $1 million to build that shed. So what's the value of building it? Is it going to bring in greater benefit than what it cost us? Well, yes, it did, and it does. So let's make the investment to do it.
Question.
Yes.
So when you were going back, if we go back to the printer example, are you able to calculate the value of going from the old printer to the new printer, the amount saved, like the financial benefit, taking out those salaries you talked about, but the actual benefit of the new printer versus the old printer?
Yes. I mean that goes into that goes into an NPV analysis. So I mean it's in reality it's a little more complicated than the simplistic example I gave, but you're looking at a lot of those kinds of variables in doing a real net present value analysis. So it's a lot more complicated than the simplistic example I presented, but the basic concept is the same. You're looking at what are the costs, what are the benefits, and are the benefits greater than the costs when those future benefits are discounted, which we're going to get to in Chapter 6. We talk about doing present value analysis. All right, let me hold you right there for a second. I know that it's 6 o'clock. We started at 5, so we're halfway in. Now, I've taught this class before. Sometimes we're having so much fun, we just barrel right through all the way to the end. Other times, I will take, a 4.5-minute break, so then we'll come back and reconvene and go again. So, since this is our first class, I don't want everybody running out here screaming the very first session. So let's take a 4.5-minute break, then reconvene. It's 6:01, so to like 6:05.5. Let's reconvene, all right?
Can you email out this PowerPoint, please?
Yes. If you have money in your 401k, you were happier today than what you were the day before. That's true.
We were in a meeting in here earlier, and the customer walked in.
The customer walked in to pay his premium.
It was so funny. The poor little man, he was like, "Oh, I'm really sorry." We're like, "Just go to the car. They'll help you."
I'm surprised. Yeah, I wouldn't think they'd have too many people come in here.
Yeah, but
Pay
you know,
premium.
those old diehard dinosaurs that like to do it in person.
They like to do it.
You definitely seem like you would fit that bill.
Yeah.
I know. I was in here with calibration with Rachel, and I said, "It's too bad I can't just stay down here, but my team kind of wanted me to come back." So.
When was celebration?
Today at 2.
Oh, yeah.
Well, I don't know. You know, we got going, so that lasted longer than normal.
Yeah, I haven't been to a celebration. I'm going to say it's at least 4 months, maybe 5. We just haven't had one. Have you done all the SI?
I have one left.
I finished the last one last night.
I'm trying to get with them to take the technical exam because every time he schedules that I was out sick or I had, or, you know, like we have a kind of crazy schedule. So he sent out this thing that Christina codes on her. And I said, I'd like you to send out one about me too, so can we take it?
Yeah, I ended up missing one on it. I don't know. I suspect it's the one where you have to use those names of the I didn't have to do it. I got my answer, but I'm home. Why would I go there? You know, I mean, I'm studying answer everything. So look at it. But I passed, and I read it irritates me that I missed one.
I know, I feel the same way. I hate when that happens. But this whole SI thing is for me.
Yeah, I not passed the camper. I passed 1, 2, and 5, and 6, but did not pass 3 and 4. And I worked on this, and their answers contradicted each other. And on one, they would say, "Oh, well, they didn't do it because they did this," and on the very next one, they said, "Oh, well, yeah, they did do it because they did the same thing."
I know. Those are some questions we have to work with. But, and plus, I was telling Rachel, if I met any suggestions for the next time, let's just have Virginia Beach and Buffalo people doing it, you know, us looking to them, as opposed to credit school people, because the very first call, the very first one was my agent, and it threw me off. So I'm trying to remember the call. I was like, oh, God, I know this was a non-necropsy guy. I know it was.
Well, that really fits about the one that they said was PPP. It was not, because if you pull up the guidelines for PPP is $100, and I'm sorry, we were looking at $47 difference.
Mm-hmm. I agree with you. I got that one wrong.
$40 out of discount loaded in on top of it that we do. I didn't know that one's very strong. I said, look, it's right here in black and white. It's our wrong.
I know I got that one wrong too. Well, plus, of course, the whole thing, you know, there's still all those different pieces of it. So just to get the overall answer right, but you better get all the pieces of it right too. And I guess sometimes when they gave an NA, so I wasn't necessarily counting an NA.
Well, after a while, I wrote a little note. So persuasion is NA if they call in stating exactly what it is.
Right, if they want to recall or something.
Right. So after that, whenever I was taking NA for it, it was fun. It's like, oh, this is good.
All right. Tell you what, we'll go ahead and get started. Before we jump back in, take a quick look at what happened in the markets today. So you can see up here in this chart in the upper right-hand side of the screen, can you see that out? Hope you can see that on WebEx. See, this is the Dow Jones Industrial Average. Say it was up 293 points, or 182%. And you see the S&P 500, Standard & Poor's 500 was up 1.83%. These are the markets closed for today. And then NASDAQ, what happened there? It's up 2.46%, 113. NASDAQ stands for National Association of Security Dealers Automated Quotation System. That is not an exam question, so you don't have to worry about it. But so these are the markets closed for today. See, wow, it went up, 293 points. Well, okay, that's only 1.82%. I remember back in 1987, that time they had it was in October, and the market dropped 504 points in one day, which we thought, okay, it was a big deal. We saw 1,000-point swings last week. Well, that time, in 1987, that 500-point drop was a 20% drop in the markets in one day, in the Dow Jones Industrial Average. So think about it. Here, it went up, and we saw last week when it dropped 600 points, it's about 3.5%. But what if it had dropped 20% in one day? Was there panic back then? Yes, there was. A lot of people sell, sell, sell. Yes, they did. What happened the next day? Stocks skyrocketed back up. Those people who sold just sold at the bottom. And the markets went back up. But if you look there, all right, so this is the close. Well, what's going to happen tomorrow? Can you gaze into a crystal ball? No. Can you gaze into a foggy, glazed wall to get some indication? Maybe. Look to the futures market. Because in the futures market, so markets are closed here, but stocks are already trading over in China and Japan. Remember, Europe's 6 hours ahead of us in London. So about midnight, 3 a.m. our time, markets roughly open up in London. So what's happening in the futures, there are a type of security instrument called there's stocks, there's bonds, there's also futures contracts, which essentially are contracts that are essentially bought on the future expectation of what's going to happen on the price of securities. So this is sometimes an indication. So look here on the Dow futures. Dow Jones Industrial Average of futures are up 26.16. The S&P 500 is up 5.9. 4.9. That just dropped. This is real time because these futures contracts are trading on the Asian exchanges and in the Australian exchange as we speak. So this changes, but sometimes this gives an indication. Now, I can tell you last week, I was looking at this. In the morning, the markets opened up, so when I look at this thing at usually 5 o'clock in the morning, futures contracts were up, showed 256. It's pretty good, up 256 futures. That same day, the market closed 600 points down. Wait a minute. So in the morning, it was pointing upward. By the end of the day, it was down 600. So this is not, so I wouldn't go and start trading securities based on what the futures markets indicate, because that's an indication, but certainly not any certainty as to where the market's going to go during the course of the day. If nothing else, what else when you get up at 5 o'clock in the morning do you want to look at except to see what's going on in the futures market? So you know what's going to happen. All right. Generally accepted general accounting concepts. GAAP, Generally Accepted Accounting Principles, and the FASB. FASB is Financial Accounting Standards Board. So after the SEC Act of 1934, the Securities and Exchange Commission wanted to establish a regulatory promulgate accounting standards. Well, so they developed this private organization called the Financial Accounting Standards Board and the AICPA, American Institute for Certified Public Accountants. Those organizations work with the SEC in drafting, creating accounting policy, accounting concepts, accounting practices. One of the GAAP concepts, they talked about this in the text, is the business entity concept. An organization's financial records contain only data related to the organization, not data related to its owners. So you look at Berkshire Hathaway's annual report, all the information in there is about Berkshire Hathaway, not about Warren Buffett. Nothing in there about Warren Buffett's personal financial holdings. It's all about Berkshire Hathaway. Now, why do you even care about these? One, because you'll see them on exam questions. We're just going to ask you, here's an example. This is an example of what accounting concept? Well, you have to know whether this is the matching principle, the materiality principle. Which principle is this? Going concern concept assumes business entity will continue to operate indefinitely. Why is it important? Why is this an important assumption? That a business entity is assumed to continue to operate indefinitely. Why would you care otherwise? What do you think?
You're going to make different financial and investment decisions if you know you're closing tomorrow.
Correct. Exactly right. You're closing shop tomorrow. You're going to make different financial decisions. And also, one of the general accepted accounting principles, concept that we look at is valuation of assets. They're valued at their historical cost. So the plaza, for example, valued at its historical cost. Well, we bought the plaza back in 1954. So when we built that. Well, it's probably worth a little bit more today than what we paid for it back then. But because if it's a going concern concept, if the organization is not going to be a going concern, you don't care about what they paid for that building 50 years ago. You want to know what is it worth today. You might have to sell it and liquidate. So one of the premises, going concern concept, assumes the business is going to operate indefinitely, which is why we can record our assets at their historical cost, as opposed to what their market value is. Now, there's some reason why do we want to record assets at their historical cost versus their market value? Why would you want to record the value of your car on your personal balance sheet at its historical cost versus its market? Exactly right, depreciation. Because the market value can change from day to day, right? We know what we paid for the plaza back in 1954. We know what we paid for this Fredericksburg building back in 1990. We don't know what the value is today. The value today could be different than the value tomorrow. So what value do you use? And whose value do you use? ABC Realtors value or XYZ Realtors value? But we know how much we paid for it. That's a figure known with certainty as opposed to current value. So again, going concern concept. What else? Money measurement concept. Well, things are measured in dollars. So on Geico's financial statements, you don't see we insure 18 million vehicles, 20 million, whatever the number is. You see dollars and cents. You don't see, IBM doesn't show in their financial statements how many mainframes or servers they sold. They show how many dollars of product they sold. The cost principle, again, goes back to purchase price. Revenue recognition principle, record at the time of sale. So there's a principle that you record your revenue, you recognize your revenue at the time of sale. Why do we care? Well, think about written premium versus earned premium. So if we sell an auto policy with $1,000 premium, we recognize the revenue, $1,000, at the time of the sale. That is written premium. And then we earn over a 6-month time period that revenue, but we record it at the time of the sale. Matching principle, match expenses with revenue. And that's linked to the conservatism principle. And you want to match expenses with the revenue that those expenses generate. Again, that goes, if you look back at, let's go to materiality. Material to the organization and users of statements. So I'm holding a pen in my hand. Is this material to Geico Corporation? No. Are the tables or the desks that you're sitting in or where you're at in your office, is that material to Geico? No. It might be worth $1,000 for that desk. Is that material to a $20 billion corporation? No. All right. Is a Hurricane Sandy that cost us $600 million. Is that material to Geico? You bet. All right. If we spend, $20 million for a new mainframe computer at our data center, is that material? Well, it is. To a $20 billion company, a $20 million purchase, yeah, well, you can make an argument. But, yeah, we think it's material. Substance over form concept. Lease as a purchase is recorded as a purchase. So, for example, in our Houston office, we're leasing that office. But a lease as a purchase gets recorded as a purchase. Well, we're not leasing that as a purchase. We're leasing it as a lease. So we're not going to record it as an asset on a balance sheet because it isn't really a purchase. But if you're leasing something and with the terms of that lease, you are effectively purchasing that, you're going to record it perhaps as an asset. Okay, concepts for the preparation of financial statements. Accounting period concepts. Prepare statements over a short period of time. That's why you see balance sheets for the year ended. You don't see balance sheets for the 5 years ending 12/31/2014. Consistency principle prevents shopping for accounting method more favorable or to manipulate income. An example of this could be changes in your depreciation methodology. Depreciation and how you record the value of inventory. Remember, under inventory, you have FIFO or LIFO, first in, first out, or last in, first out. And they want some consistency in how you record the value of assets. You can't go and change how you record the value of assets to get a more favorable financial picture or to manipulate your income. Does that mean a company cannot ever change how they, their accounting methods? No, they can't change their accounting methods. They can't change it from year to year to year. There has to be some consistency. You also have to have a good explanation that's going to pass muster with their auditors. And depending upon the company, it may pass muster with the SEC on why you're making that change in your accounting practices. Then a conservatism principle requires recording transactions not to over or understate the balance sheet or income statement. So think of this conservatism principle, and I'm going to look to our claims folks in Virginia Beach. How do you exercise this conservatism principle in your job as a claims adjuster? Do we have somebody in Virginia Beach claims still on the line?
Reserving.
Reserving, okay. What do you mean by that? Give me an example.
Setting aside, case and stat reserves based on the probability that we'll be paying out for a claim.
Right. So we put established reserves of what we expect, perhaps based on the information that we have at a point in time, what is our ultimate amount that we expect we're going to have to pay out in this claim. And let's be conservative in our setting of the reserve. We're going to set our reserve for what we anticipate we're going to pay out on this claim. right? I spend a lot of time working on workers' compensation claims for Geico associates who sustain a workplace injury. And for those claims where if we have an auto damage adjuster who's involved in an automobile accident and he gets hurt, he or she, you have to go to the hospital, they incur medicals. What is the estimated ultimate value of their medicals going to be? If they lose time, how much time are they going to lose from work that they're going to get paid by workers' comp? Well, we have to estimate that, and we want to set our reserves what we anticipate to be the ultimate amount that we're going to pay out on that claim. And that's taking a conservative approach to setting of reserves in this case. If you read the 40 years of Geico history, go all the way back to the 1970s, Geico's reserving practices, we were not necessarily exercising the conservatism principle very well. That got us into financial trouble. Tell you back in the late 90s, Travelers Insurance Company and Fireman's Fund Insurance Companies both got into trouble because they were woefully under-reserving claims that they had in their books for environmental impairment and pollution claims. I remember specifically example, Travelers had to take a $900 million increase in their reserves for under-reserved claims in 1 year. Think of also a balance sheet, right? Assets, liabilities, owner's equity. Is reserve a liability? What if also your liabilities went up by $900 million? You didn't have a corresponding increase in your assets that go by $900 million. So where'd the balancing have to come out of? Your owner's equity. When you're a stockholder, are you very happy about that? No, also the value of your owner's equity went down by $900 million. And then there's all the ill will from investors, the regulators, and policyholders. Look, they're not doing a very good job of managing their organization. They have to take almost $1 billion increase in their reserves. They were not exercising that conservatism principle very well. International Financial Reporting Standards. Okay, what is that? It's the independent standard-setting body of the International Accounting Standards Committee Foundation. All right, in the text, and there you actually see on an exam where they ask, how are GAAP, generally accepted accounting principles, and international financial reporting standards similar? And if you read in the text, they're similar in that they use fair value reporting for many assets, such as intangible assets and financial instruments, derivatives, equities, debt securities. So they're similar in that they use fair value accounting. Think of fair value accounting is equal to, well, what's the market value of an asset? In this case, it is intangible assets. So international financial reporting standards versus generally accepted accounting principles, one of the major differences is how they handle the valuation on intangible assets. For the similarities, where they are different is in reported values of property, plant, and equipment. So think of your balance sheet again, on your fixed assets, property, plant, and equipment, inventory. So generally accepted accounting principles uses blank, and International Financial Reporting Standards uses blank. Fill in the blank. What?
Historical and reduce fair value.
Correct. Historical cost by GAAP and fair value by International Financial Reporting Standards. What's the effect of the differences? Knowing where the difference is one thing, understanding the effect is something else. What's the effect?
Your assets are going to look larger with the international financial reporting, probably.
Correct. Right. Potentially, if the market value of your assets has gone up,
Or it could look worse.
Or it could look worse. Right? So one, there could be a lot more fluctuation in the value of reported assets. Because at the end of this year, you use fair market value, and then a year later, you use fair market value. There can be a lot of fluctuation versus historical cost was the same last year as it is this year. You know how much you paid for this building. But the value of this building in the marketplace is going to vary over time. Okay, and then another difference is GAAP, generally accepted accounting principles, is very rule-based versus international financial reporting is more principles-based. Now, I also put in there GAAP versus IFRS versus SAP. What is SAP? Other than something that comes out of a tree that gets made into a maple syrup? What is SAP? Because at Geico, we have people who live and breathe, and all they do is SAP, statutory accounting principles. So years ago, I was in a meeting here in the Fredericksburg office where our then CFO, Chief Financial Officer, was giving a talk. He said, well, insurance companies need to maintain 3 sets of books. 3 sets of books. Why? Well, one, they need to set this is before international financial reporting standards even came about. One, we need to keep a set of GAAP-based books. So a set of books based on generally accepted accounting principles. And we need to keep a set of books based on statutory accounting principles. And we need to keep a set of books for the IRS. Now, does Boeing, IBM, Walmart, Microsoft have statutory accounting principles? Right, they don't. That only applies to insurance companies. But again, those statutory accounting principles, and we're going to look at more of that in later chapters, and we'll look at more in the differences between GAAP and SAP-based accounting statements. Yes?
So are the statutory, is that by state, or is it a nationwide set of principles? Do we have to prepare it differently for every single state we work in?
Right. Statutory accounting principles are promulgated by the NAIC, National Association of Insurance Commissioners. The NAIC promulgates SAP, statutory accounting principles. Now, depending upon the state, there may be some variations in states. Principally, it's going to be New York. But for the most part, they use the promulgated statutory accounting principles that are put out by the National Association of Insurance Commissioners. That way, insurance companies nationwide then can have the same basis in which to operate and prepare those financial statements. For the most part, they use the NAIC principles.
For the CPCU tests, how heavily are all of these acronyms and governing bodies and groups mentioned or tested?
Well, as far as the acronyms, they will spell out the whole word instead of SAP and statutory accounting principles. Do you want to know them? Because here at Geico, we are, of course, we're fanatics for acronyms and abbreviations. But also, boy, it's a mouthful. Statutory accounting principle versus SAP. Okay. I know in that same discussion years ago with the then CFO, who's long ago retired, he was talking about GAAP versus SAP accounting. And he didn't say statutory accounting principle. He said SAP. And I looked around the room. I had already taken CPCU by then, so I knew what SAP meant, as you do now. probably 2/3 of the people in the room, their eyes glazed over, they had no idea what he was talking about. But he didn't bother to explain what it meant either. He just, well, figured we're insurance professionals, we know. Well, now you know. So the next meeting you're in, well, Bill Roberts comes in and he asks, what is SAP? You can hold up your hand, stand up, and say it's statutory accounting principle, because you'll know, right? There's a lot of people don't. But the second part to answer your question is let's go take a quiz. So we're going to do that right now. Well, let's see, where am I? So we're going to go, so I'm going to take you home so you know where to go. All right, if I could type, I'd be dangerous. There we are. So this is where you want to go. Go under Study Materials, and you see Smart Practice Exams. You click there, takes you to this page. You click Log In. And it may take you to now. Takes you to this page here. Now, I've already logged in, but the next login page is where you put in the user ID and a password. If you don't have one yet, then you get a little button there to create one. All right? I've already created a user ID and a password. I just type that in, takes me to this page. All right, so I'm a student. Study Materials. Smart Practice Exams. So you go here. Learn more, activate your Smart Practice Exam now. So when you get here, you're going to use that code that's in the front cover of your study guide. Right there, access code. You're going to type in that access code. Now, I've already done that. So I'm going to click to My Online Learning. Okay. There's 540 Smart Practice Exams. Now it says 2013, but it's the current exam. They haven't updated that terminology.
How long do you have access to all of this material?
It's say back there.
You have access for a year.
Right. See, right. It tells you there. Here's the date I enrolled, and it expires September 3rd of 2016. So I'm logged in. Here are your chapters, your exams. Take the exam, and then you take this final exam that takes you, that just mixes up all 12 chapters all at once, or you can do it chapter by chapter. I would recommend you start with chapter by chapter. Click on that button, take the exam. All right, so I did first time here. All right, so the 1 attempt, 2 attempt, 3 attempts, 4, 5, 6, 10, however many attempts you take. Now, one of the things you'll see on there, you look and say, gosh, Wander, you're the instructor, you only got an 80%. Now, one reason why I did that, and as soon as I did, I realized I read the question wrong. It can happen. It'll happen to you. That kind of points to, one, the importance of reading the question the first time, then go back and read it again. And then the importance of taking this quiz over and over and over again, because then you'll see that same question over and again. you'll see that same concept questioned differently. But this also gives you a feel for, here's what the real exam is going to look like. So you know you'll be well prepared by the time you get to the real exam to take the exam. So we're going to retake this assessment. So I encourage you, if you go and you take it the first time and you get an 80, you get 100. If you get 100 the first time, go back and take it a second time to see if you get 100 the second time. And if you got an 80 or 50 or whatever the first time, go back and take it again. Go back and take it again. And keep taking it until you get 100. And again, you only help yourself prepare for the national exam by doing that. And don't wait until we're halfway through the course and say, oh my gosh, I haven't done any of these yet. Let me go back and start with chapter 1. We're already on chapter 6. So part of your study that you do each week is go ahead and take those online practice exams. Now know that I'm doing the same things. Every week I'm going to be going, logging in, doing the online practice exams. So here's the first question. So what I'm going to now, we're going to, it varies. In this case, I think there are 15 questions. When we go all the way to the end, you put in the answers, and then when you're all done, then you click on a button that says, all right, submit, and then it'll come back and tell you your grade and tell you which ones you got right or wrong. So let's take this question number 1. Accountants are able to ignore generally accepted accounting principles when recording insignificant items. They're following what principle?
B.
B, materiality. Okay. All right, now, we don't know if we got it right or wrong. I know that being an astute CPCU student, who was that?
Oh, that was Rupal. That was me.
Okay, good. All right. So thank you for taking the first stab, all right? Question number 2. The focus on finance activities is on what?
D.
Maintaining and managing an organization's capital. Okay. I'll put the answer, and then we'll see if we get to the end. Sean owns a men's retail clothing store. They had a fire. The adjuster asked for financial statements. What are they most likely to use those financial statements for? What do you think? And while we're thinking, why doesn't what?
C.
B or D?
C, Charlie.
C for Charlie, okay. Estimate the inventory on hand at the date of loss, okay. 4, which of the following is a function of a corporate finance department? Now, somebody here in Fredericksburg, be brave. What do you think? What? C. Okay. All right. Question 5. Measurement of economic income differs from organizations' accounting income measure. Which of the following is true? What do you think? Somebody down at Virginia Beach. Which one of those do you think is true regarding the difference? Now, Virginia Beach, somebody's got to speak up quick, otherwise somebody here in Fredericksburg is going to take the question.
I'll take a shot at D.
At D? Okay. All right, now question number 6. Now, whatever the question is, I'm going to ask the consensus. Does everybody else kind of agree with the selected answer? Question number 6. The Corporate Code of Ethics provides what?
A.
A. All right. Financial transparency to management. Does everybody agree with that?
D.
Yeah, I think D.
D.
C, yeah.
D as in Delta.
D is in Delta. Okay, so Delta. All right. All right. So we have 2 votes for D, 1 for A. Now 2 points generally make a straight line, so we'll go with D. All right. We'll see how we end up. Okay. Question 7. So which gap principle is being illustrated here?
C.
Cost. D.
C.
Okay, I have 1 vote for C and 1 vote for D, cost.
Charlie.
Okay. Charlie, so now I have B, C. Can I interest anybody in A? Okay, what do we think?
Take off the D. I just reread it.
You just reread it, okay. All right, question 8. The treasurer of a corp is deciding to implement changes in the capital structure. She expects the total value of the corporation to what? Go up, down, remain the same, be less predictable? What do you think?
I think C, which is increase.
C, increase. Okay, 1 vote for C.
Charlie.
What?
C is in Charlie.
C, so I have two votes for C.
3 votes for C.
3, okay.
4.
All right.
Feeling more confident now.
No, there we go. All right. So 3rd quarter, influenza epidemic. Increased the demand for the flu vaccine. So the value of their vaccine supply increased from 36 to 50 million. The $14 million increase represents what?
D.
An increase. What?
Delta.
Delta. Economic income. Okay. Why'd you say economic income?
I guess the other 3 are ways to measure the type of income, whereas there's actually an increase in the value of it.
Okay. All right. So think of it in terms of like an unrealized capital gain. They haven't sold the vaccine yet, but now the demand for it's greater. So now it was worth $36 million. Now it's worth 50. It's an unrealized capital gain. But we'll see if it's actually economic income when we get to the end. Question number 10.
A.
A.
A. Lots. Okay, we'll go with A.
A.
A. All right.
Yeah, potential insurance. Should be handling their claims that we don't insure them yet.
All right, question number 11. The conservatism principle requires what?
B.
Bravo.
Okay, 2 votes for B.
Bravo, B.
B, all right, okay.
I agree, B.
All right, let's go to the underwriters at Wheaton Insurance Company. The underwriters are using this evaluation of the client's assets and liabilities for what?
Alpha.
A.
Okay, all right, 3 votes for A. We'll go with A. Let's see, question 13. Which of the following statements is true? What do you think?
D. D for Delta.
D for Delta. Okay. We'll go with that, see how we do. Question 14. Which of the following would be the best reason for maximization of shareholder wealth as a goal?
Delta.
Delta.
D.
Retain customers.
Okay. Sarbanes-Oxley, otherwise affectionately known within Geico as SOX. What?
A.
A, alpha.
Okay. All right. Now, what was the show on TV? Is that your final answer?
B.
Yeah. Okay. Let's see how we did.
Ouch.
Ouch.
You let us do it.
That was painful. All right.
You learn.
This is how you learn. All right. Let's see. Oh, great. We got into question number 1 right. What a deal. Here we're on a roll here. 3, 4. Measurement of economic income of an organization differs from measurement of accounting income. So the correct answer, it highlights the correct answer for you in this case, which is B. And all right, the incorrect one that you chose, D, and it says, okay, here's incorrect. Economic income is based on fair market value rather than historical value, and that is B. Okay, 6, 7, all right. So the books of the business show the property of value property at its depreciated value rather than its purchase price.
Oh.
So the principle is conservatism. GAAP conservatism requires that alternative solutions are available, at least one likely to overstate income and assets be chosen. All right. So let's look at 8. Increase. The total value remains the same. Now think of it this way. Go back to your example of you bought a car, $2,000 in equity, an $18,000 loan from the credit union. That's the capital allocation that supports the $20,000 value of the asset that you purchased. If you go and change that, and instead of 80-20, you put down 50% of the purchase price in cash as equity, and then you finance $10,000 through the credit union. The mix of capital differs, but the total amount remained the same. The cars were $20,000. The value of the asset didn't change, but the mix of capital, you put down 2, you took a loan for 18 versus you put down 50% and you took out a loan for 50%. The mix of capital changed, but the total value remained the same. That's why D is the correct answer there. Let's go back and see what else we got. Go back to page 2. Question 11, 12 we got right, 13, 14, okay. Which of the following would be the reason the maximization of shareholder wealth? To maintain a market to raise additional capital. So if maximization of shareholder wealth is maximizing the value of the stock, then to maintain a market to raise additional capital, well, if all of a sudden the value of the stock is going up, that means people will want to buy your stock because they want to get stock that's going to be going up in value. So that helps establish and maintain a market for you to raise additional capital, because if nobody wanted to buy your stock because the value of the stock is staying the same or going down, you don't have a market to raise additional capital. How you have that market is by the value of the stock going up. Sarbanes-Oxley, the last one. It created a board to regulate public accounting firms that audit publicly traded corporations. Prior to Sarbanes-Oxley, there was not a board to regulate public accounting firms. Essentially, you have accounting firms audit corporations. Okay, who's auditing the auditors? Well, Sarbanes-Oxley essentially established a board that essentially audits the auditors. But before Sarbanes-Oxley did not exist. All right. So that's practice exam for Chapter 1. Now you see how you log in, how it works. You go through, answer the questions. Some chapters, there's only 10 questions. Fine, I can go back and take the quiz 2 or 3 times. That way you'll get a different mix of questions the second time. You go back in, take this the first time, then you take it a second time. You'll get it. A few of the questions will be the same as you saw the first time around. And then you'll see a different mix. Every time you go through it, you'll see a little different mix of questions. But that's how you prepare for examination. Right? So next week, then, Chapter 2. Now, what I will do is I will go out and email out to the list group that I have, set up for this class, so everybody will get a copy of the slides that we went through today. So what I will do going forward is at the end of each class, and then we'll go ahead and email out the slides for that day. Similarly, if some of you have been on a webinar before, you have to go through the webinar, and then the presenter at the end says, all right, then we're going to go ahead and we'll send out copies of the webinar slides to all of the participants. I've found in the past sometimes if I gave the slides out here. Wow, okay.
What was that?
I'm not going to send them out before class, is that people get the slides on Monday. Here's what we're going to talk about on Wednesday. I don't know. And I think this is the phone telling me time is up. So next week, same time, same place. Thank you.
Thanks, Sam.
Thank you.
Bye.
Bye.
Bye. Bye.